All right, it's time to bring in my next guest. That's going to be Phil Strebel, Chief Market Strategist at Blue Line Futures. Welcome back to the show, Phil.
Yeah, thanks for having me, Tom.
All right, so just real quick on equity markets here, with the levels that we've seen, the broad-based rally that's kind of broadened out a little bit. It seems like the optimism in the equity market pretty robust here, even though historically, Phil, we've got a volatile month end of September into October. What's your thoughts?
Yeah, because we were past that September option expiration, so that's a big relief for the market. So there's only 7 trading days left, or 6 trading days left for the rest of this quarter here. So expect the market to have a little bit of volatility. We've seen the average true range on some of these stock indices coming up ever since the Fed meeting. And then after that, the focus will be 35 days out, where we go to the election, and then you want to position, as for the year end after that. So historically, on an election year, from the election on S&P 500, I think it rallies like about 2.3% on average. So it seems like the melt up that's going to go on to the end of the year is more likely the scenario, rather than a crash and burn or anything like that. I do think that if you're going to play the downside of it, I think the best way to do it is using a calculated risk strategy, something like a put spread, use month-end options, things like that. So that's kind of the way we've been playing it and the way we see it.
Yeah, and Phil, when you look at this, that narrative about the soft landing, I think that creates that optimism, that a wealth effect that the market's going. But are there risks when you mention that maybe that grind higher might be the consensus call at this point? There's still maybe some downside risk, and would that recalibration of maybe a 3 to 5% pullback be the more likely scenario before we continue to rally into the year end? Because I think that's the narrative that a lot of maybe investors out there are thinking at this point.
Well, I mean, hope's a terrible strategy, but yes. I do hope that we get some kind of pullback here, because of the fact that we have been, when you start rising near all-time highs, it doesn't matter what asset class is, you tend to trim positions off and things like that. And you get down to your minimum, and then you feel like you're missing out if the trend continues. So we definitely want to see some kind of correction. You mentioned the Dow earlier. The Dow was the one that really turned the tides higher, and that was the first stock in to see, like on our programming, that had went to a bullish trade. And then it was, the S&P followed, and the weakest one right now is the NASDAQ still at the moment. The Russell looks fantastic. All of them to the upside. They all look really good. I mean, if you forget what the underlying asset is, look as a technician, when the chart goes from the lower left to the upper right, it's a fantastic asset.
Yeah. And speaking of fantastic assets in 2024, Phil, we've got to talk gold, because it hit another high overnight. And this kind of goes against my theory. I get that interest rates are falling. That's going to help support gold at this point. But also, is there some inkling out there that central banks continue to buy with the equity markets moving to all-time high as maybe a safety player hedge here?
Oh, 100%. They're active buyers out there, all the central banks, and even the ETF flows. We saw 3.5 million ounces flow into global gold ETFs over the last week. So they're starting to come in there. Usually after the first interest rate cut, it takes 30 days for the retail investor to start allocating cash into those ETFs. So we should see that lift the market as well. But I mean, I think gold, you look at it here today, all the other metals are under significant pressure. Gold is basically trading on either side of unchanged. We saw weaker French and European PMI data, and that's what really put the pressure on the base of the industrial metals. It took down the euro currency, it lifted the dollar index, but you could see gold's resiliency, because what gold thinks is, it thinks that, hey, there's the possibility for this 50 basis point cut. It's like a 53% chance right now at the November 7th meeting they'll do so. And then also that miss of PMI data over in Europe says that, hey, maybe those guys are going to cut more aggressive and more faster. So we'll reach the terminal rate quicker, and that's what propels gold higher.
Yeah, and those rates coming down. Now the dollar had been weaker, but then that firmed up into the end of last week. Also, now we're at the 101 level for the dollar index, a spot. I mean, do you look at that creating more headwinds, or do you think there may be some weakness in the dollar moving forward that could also support gold?
I mean, the environment that we're in, the Fed's obviously dovish. The U.S. dollar should be cycling to a new low. Inflation should start to reaccelerate. We should have a stagflationary period for at least the next couple weeks. So it's the pace of the interest rate cuts that I think really affects the dollar index. I just love seeing the dollar bounce back though, because of the fact that there's so many people out there that just hate the dollar index and think that it's completely worthless. So I like to see a little bit of a rally there just to stick it to them.
And it's not surprising, that the equity market, they loved it when the dollar was coming down for those multinationals, right? But at the same time, even though it's firmed up and started to move higher over the last few sessions, it doesn't seem to be creating many headwinds for equities at this point. But you look at some of those other metals, silver's hung in there pretty good. But we finally saw a little bit of a resurgence in copper last week or over the last couple of weeks. Do you see that trending higher if PMIs, which in the U.S., kind of firmed up a little bit, but there's still maybe recessionary environment for a lot of the, the industrial uses for copper here at this point?
Yeah, and the copper market was one that I got that one wrong. I was taking more of a bearish stance on the copper market because of the fact that I thought that China continuing to weaken. They're the largest consumer, second largest economy. I thought that the prices would have retested the $4 level. To have a 34-cent rally from the September lows to the highs is pretty incredible. But where you can, what I should have been watching was Shanghai, LME stockpiles, things like that. They were declining at a pretty rapid pace, and it just shows you that those supplies are strained. And if they get if China does some kind of stimulus measure, you're probably going to see copper prices go into another one of those squeeze type of mentalities, and then it's going to pull that silver market up dramatically. And that's how you get silver, over 32 and a half, 35, 40 bucks. But you just got to keep an eye on the copper market. It looks really good right now. I know that we were actively trying to buy some of the sell-off that we saw in the overnight session. I think some clients got filled.
Yeah, and when you look at, moving forward here, Phil, when you're looking at clients and what they might think here with the equity markets here, what are you telling them? Are you putting them in strategies or kind of giving them some type of, guidance maybe for some of your clients that, hey, there's good ways to hedge maybe these long positions in equities and some of these other asset classes?
I got to tell you a secret, Tom. All the clients that I work with on the equity side, they all hate the equities. They think that they think that it's going to crash and it's all over. So we keep buying like put spreads and things like that for them just to keep, because of the fact that like we've seen it where like the NASDAQ looked like it was going to roll over. And if you'd have shorted the NASDAQ, good Lord, with 500 point, 600 point moves and it's $20 a point. I mean, thankfully the CME's got a micro contract now. I think the only way to play this is through put options and things like that and put spreads at the moment. I just don't see like coming in with just at least being able to nail the top or anywhere close to the top. I just don't see it at the moment, because that's the problem is when you have a melt up, you don't know what's going to stop it from melting higher.
Yeah, and I always look at it this way because I've been an options trader for 30 years. It's like, hey, if you're not comfortable with the equity market, start selling some call verticals or something above the market at this point, where you still gives yourself a little bit of a cushion. But just give me your real quick take here going into the election over the next several months. Is the optimism warranted here for equities where you should be comfortable being in them?
So if you talk to like the retail investor, they'll say that they want to like pare back their equities because of the uncertainty surrounding the election. But I don't really see, much uncertainty at all, because we've already seen the previous administration. We've seen Trump in office before, so we know what to expect. I think you could take the kind of the COVID thing out of it and look where his first maybe 3 years the economy had traveled. But I think that the equity markets, they do look pretty good here. I mean, bear in mind that the Fed is not making another 50 basis point cut as a panic cut because of the deterioration in the labor market or something like that, and real bad signs of the economy. I think that that's the only thing that might be able to turn the tide lower.
Yep. Decent labor market at this point. Economic data has been relatively decent at this point. So, maybe that soft landing narrative will play out. All right, great discussion, Phil. Appreciate it.
Thanks for having me.
All right, that's Phil Strebel, Chief Market Strategist at Blue Line Futures. Join us, but coming up after